Namaste. In this video, we will discuss about introduction to INDs. INDs are used for preparation and presentation information in the financial statements of the companies, and financial statements are tool for describing the financial position, performance, and change in the financial position of the equity, and that is helps different stakeholders in making the economic decisions, whether they are the investors, bankers, debtors, creditors, etc., etc. Due to increased complexity in the business and globalization, a need was felt for following the uniform principles and formats for preparation and presentation informations to the stakeholders, because it will enhance the international comparability and quality of the financial information. Earlier, different countries were using different accounting standards, and the information was not comparable and of that quality, and it will reduce the information gap between the capital providers and people those are investing money, and it will increase the transparency of the information that is provided, because there are similar principles are used for presenting the information in the financial statements. Apart from it, it helps investors to identify the opportunities and the risk across the world, and apart from it, it lowers the reporting cost also, because if a company has operation in different countries and the similar principles are used for preparing the financial information, it will obviously reduce the cost. Otherwise, it has to make financial statements according to the related different accounting principles. Apart from it, it also make it easy to consolidate the financial statements and reduce the number of different reportings for the purpose of entity. So let's discuss about the journey of accounting standards in days. In 1973, International Accounting Standard IASC was formed, and the standard setting board of IASC was known as IASB, and the standards those were issued by IASC board was called IAS, International Accounting Standards. Later on in the year 2000, for the purpose of creating uniformity between the different countries' accounting standards, whether it is a IAS or US GAAP or different standards, those are used by different countries. To create the uniformity, IASB was formed, and it was decided that it will work under IASCF, that is known as the IFRS Foundation, and standard issued by IASB are called as IFRS. So there were two standards those were issued. One is the IAS, and later on, for the purpose of uniformity in the global environment, the standards those were issued was called IFRS. Later on in the year 2002, regulation was passed by European Union to prepare financials as per IFRS since 2005, and there was a joint convergence project that was launched by G20 countries in 2009, but India did not committed for the convergence in this G20 summit. Later on, India committed to convergence since 2011, but MCA notified this convergence in February 2015, and it was decided that we will go phase wise implementation. So in India, the it was started in 2015 when the ministry confirmed for the implementation of it. So let's discuss about the India's issuance process. In India, issuance and updating of IFRS is done by IASB, and for this purpose draft is prepared by ASB, and it is circulated to different members of ICI, council members of ICI, and specified bodies those are related with the financial statements like SEBI, MCA, C&AG, and CBDT for their comments. And thereafter they held meeting with the specified bodies and finalized the draft for public comments. And after considering the comments that have been received from the public and the industries, final draft is submitted to NFRA. Earlier it was called NFRA is National Finance Reporting Authority. Earlier it was NACAS, National Advisory Committee on Accounting Standards. And once the NFRA notifies NDAS under Companies Act, it becomes applicable. So this is a journey how the need was felt for the uniformity of principles and formats, and how it was uh, come on the ground in form of globalization and implemented in India. So when it was decided for the synchronization and convergence in the India, so first challenge that come how to implement it. So there are two methods for implementation. One is the adoption. Adoption means it is implemented as it is. The another method that companies that confirm India decided that we will go for the convergence. Convergence means implementation of global standards with some changes. So if India disagrees with the IFRS and removes or modified it, it is called carve out. And if India adds something new that IFRS does not have, it was called carve in. And if IFRS allows two or more methods but India is restrict to it, it is called option restrictions or removal of the options. So in the process of convergence, we followed there are that resulted are carve outs where there is a disagreement with the IFRS and we are following our own standards, and where something is not mentioned in the IFRS because of the global local need, we have added information in the IFRS that is called Carvin. And if multiple options are allowed in the IFRS and we have opted for one, this option is called option restrictions. Another challenge that was faced was how to number Indias. So there were two types of standards. Those were exist. So those were IAS, those were from 1 to 41. However, board has repealed some international accounting standards. So these IAS, those were converted in Ind AS, are numbered as Ind AS 1 to 41. And the IASB, those have recalled the IAS and have issued new standards that they have called IFRS. So till now, 17 IFRS have been issued, and in India, these IFRS are numbered from 101 to 117. So there are two series of the Indias. If IAS has been converted, it is numbered as 1 to 41, and if IFRS has converted, the new series has started from 101 to 117. So if we are talking about Indias 2, so it means it is IAS 2. And if we are talking about Indias 109, it means it is IFRS 109. So this is what they have numbered the Indiases. And apart from this, there are standing interpretation committee. Those have issued the interpretation, and different bodies also, that is called International Financial Reporting Interpretation Committee, that has issued IFRIX. So these interpretations in India have been added in accounting standards as a appendix. So now we will discuss about the India's applicability roadmaps. So in India, as we have discussed, it is implemented by phase. So in phase one, there are two conditions that we need to look after about the applicability of India's. First is net worth, and second is the company type. So in phase one, where the company is having net worth for more than 500 crores, and this company is listed or is in process of listing, whether in or outside India, and all the unlisted companies having net worth for more than 500 crores, Indias are applicable from financial year 2016 and 17. And for the companies, those are having net worth for more than 250 crore but less than 250 500 crores, indices are applicable on all the unlisted companies and all the listed companies irrespective of the net worth since 1718 financial year 1718. So all the listed company irrespective of the net worth indices are applicable since financial year 17 and 18, and this clause remain net worth clause remain applicable important only for purpose of unlisted companies. For the purpose of unlisted companies we need to check about the net worth, otherwise all the listed companies have to follow indices since financial year 17 and 18. And in phase 3, with the same net worth of 500 crore more, it was decided that scheduled bank and insurance and NBFCs will follow the Indian accounting standards since financial year 17, 18 and 19. And in phase 4, it was decided that unlisted NBFCs having net worth for more than 250 crores were follow the Indian accounting standards since 2019-20. Apart from it, if indices are applicable to any company, its holding subsidiary and JV or associates are supposed to follow the index. And voluntary adoption of index was also permitted since financial year 15-17, and it was not there for NBFC. So NBFC cannot voluntarily adopt the indices. It can adopt index only when it falls in the category of respective clause. And once index has been applicable, company need to continue to apply it in near future. For example, if there is an unlisted company having a net worth of more than 250 crores, and in next year the net worth has come down to 100 crores, but it cannot stop making financial statements according to Ind AS. Once the accounting standards has been applicable, the company need to follow the same principles in coming years also, irrespective of their net worth. And there are some exemptions also, that certain small companies, partnership, and private entities are not required unless they meet the threshold limit. And companies those are listed on SME exchange are not required to apply Ind AS. So if we check the net worth, it is important to check only from the perspective of unlisted companies, and we need to check the net worth as per the audited financial statement of as on 31st March 2014 for the purpose of applicability, or first audited period thereafter. So for the purpose of calculating net worth, we will check the paid up share capital and we will check the reserves, and we will check the reserves. Those are created out of the profit only. The revolution reserve, etc., or capital reserves, amalgamation reserves, or those are not created out of profit, will not be considered for calculating the net worth. And out of it we will reduce the accumulated losses, deferred expenditures, and miscellaneous expenditures. Those are not written off. And net worth to be calculated on basis of standalone statement, not on CFS basis. So if we check about the exclusion, the revolution reserve, it is excluded since it is not generated out of the actual profit, and capital reserve also because it is not from the operating profit. Share application money pending for allotment, this is not part of capital until shares are allotted, so it will also exclude. Proposed dividend is not a free reserve, so it is an obligation once declared, so we will remove it. Reserves created out of the right back of the depreciation, amalgamation adjustment, because not actual profit. And similarly, foreign currency translation reserves, it is not unrealized, hence excluded. And other comprehensive income balances, generally unrealized, are excluded unless transferred to free reserve. So it is included only when it is realized. So let's discuss about some examples about it. So, for example, this is a snapshot of audited balance sheet of a company A as on 31st March 14, and company A's equity share are listed on Bombay Stock Exchange. So, first thing that we need to check whether it is listed. Yes, it is listed on the Bombay Stock Exchange. Then we need to check about the net worth of the company because it is talking about 2014. So, for the purpose of calculating net worth, we will take the equity share capital, we will consider security premium, we will consider general reserve, but we will not consider revolution reserve because it is not from the operating profit of the company. And apart from it, reduce the we will consider the profit and loss also, and we will reduce the expenses those are not written off. So let's check. It is similar and net worth comes 505 crores. So hence the India's will be net worth of the company is more than 500 crores. So it will be covered under phase 1 for implementation purpose. So next question is, will your answer changes if company A is an unlisted company? So here, even though the company is unlisted, the net worth is more than 500 crores, so answer will not change. Even if company A is unlisted company A's net worth is more than 500 crores, so it will be covered under phase 1 only. Another example, if we take, let's say, in illustration 1, the balance of the profit and loss account is negative 375 crores. In this example, it was PL balance was 75. So it is saying that it is negative 375 crore. So when the Ind AS would be applicable to the company, will your answer change if a company A is unlisted company? So in case of listed company, it will be covered irrespectively in phase 2, because in phase 2 all the companies those are listed have to be covered irrespective of the net worth. But next question is, will your answer will change if A is unlisted company? Yes, because in this case the net worth will play a major role, because phase 2 is only applicable for the unlisted companies. All the listed companies are covered under phase 2. So in illustration 3, let's see the net worth of the company B, that is an unlisted company, was 600 crore as on March 2014. However, due to losses incurred in 14-15 next year, the net worth of the company was 400 crores as on March 2015, from when company B shall apply Ind AS. So, as we have already discussed, if once the Ind AS has been applicable to any company, it cannot go back. It has to apply Ind AS irrespective of the fact that later date net worth falls below the specified criteria. So next is the net worth of C, that is an unlisted company, was 400 crore as on March 2014. However, the net worth of the company was 600 crores as on March 15, from when company B shall apply Ind AS. So in this case, Ind AS will become applicable to such a company in the immediately next financial year. Hence, in the present case, company C is covered by phase 1 of the roadmap, and accordingly Ind AS will be applicable to company C for accounting period beginning on or after 2016. Because as on March 15, the net worth has increased to 600 crores. Next is company D is a parent company of group A. Company A is unlisted company and having net worth of 60 crores, and following are the other companies in the group. Company B is unlisted company, subsidiary of A, it is having 600 crores net worth. So if a company is having NDS is applicable to a company. In this case, company A is NDS are applicable to company A because the net worth is more than 500 crores. In this case, we have learned that the subsidiary and financial the parent company is also required to prepare the financial statements according to the NDS. So hence, NDS will be applicable to all three companies, that is A, B, C. Next is following is the structure of company D. It is having company E, and E is having two subsidiaries F and G, and there is a different structure company H and I. All the companies in the above structure are unlisted and having net worth of, and the net worth of company E is 300 crores and net worth of the other companies is below 250 crores, to which company Ind AS will be applicable. So if we see for the unlisted company, if the net worth is in phase 2, net worth is more than 250 crores, the Ind AS will be applicable. So in this case, Ind AS will be applicable to company E. And second case is if Ind ASs are applicable, it will be applicable to the parent company as well as the subsidiary company. But in this case, the fellow company are not required to follow the Ind AS because they are not directly connected. H and I are not supposed to follow the Ind AS. Let's see. This requirement does not extend to other fellow companies of a holding company which is required to adopt Ind AS. Hence, the other company of the group, that is H and I, will not be covered under Ind AS. And the E will be covered under phase 2, and hence the company F and G and holding D, these four companies will be covered under Ind AS applicability under phase 2. Next is ABC is incorporated in foreign country having a net worth of 700 crores, and it is having two subsidiaries X, which net worth is more than 600 crores, and Y is net worth is 150 crore. Whether X and Y would be required to follow Ind AS from the accounting period commencing on or after 2016 on the basis of their net worth or on the basis of net worth of the ABC. So here question is whether the subsidiary Indian subsidiary companies, those are having parent as a foreign country, will require to follow the Ind AS. So if we check X net worth is more than 500 crores, so it will be required to follow the Ind AS, but ABC will not be required to follow the Ind AS, although the net worth is more than 700 crore because it is not an Indian company. So company X is having net worth of 600 crores at the end of the financial year 2015. It will be required to prepare its financial statements since April 2016 as per the Companies Act, while the Y having net worth of 150 crores in 2015 would be required to prepare its financial statement as per, not as per Ind AS but as per accounting standard. Since the foreign company ABC is not a company incorporated under Companies Act, so these rule will not be applicable on it. So it is not required to prepare its financial statement as per Ind AS. So now let's discuss about some relevant sections of the Companies Act. Those are having their link to Ind AS. Section 2, subsection 2, it defines the accounting standards. It includes Ind AS notified under section 133 and section 133 where government notifies the Ind AS to the industries. Section 129 where financial statement and CFS must comply with Ind AS. Section 134, it includes the director's responsibility statement that financial statements are in conformity of Ind AS. Section 143 talks about the auditor's report that must state compliance with Ind AS. And section 230, it talks about the schemes of arrangement accounting treatment must follow Ind AS. And section 66 that talk about the where company apply for the reduction of share capital auditor certificate should be there of Ind AS compliances. So next thing is that we need to discuss about the division 2 to schedule 3. So it talks about the Ind-AS format of financial statements. Division 1 of schedule 3 talks about the format of financial statement as per accounting standards, but division 2 is incorporated for the purpose of financial statements as per Ind-AS. So schedule 3 to Companies Act notified on 29th August 2013 that provide general format to financial statements, and division 2 as we have discussed was inserted, and this is applicable from first Ind-AS financial statements and there onward, and the scope and exclusions are division 2 applies to all Ind-AS compliant companies except it is not applicable to insurance companies, banking companies, and NBFCs. For NBFCs, although NDSs are applicable according to the threshold limit, but a separate format is prescribed under Division 3 of Schedule 3. And if we check about the structure of Division 2, Part 1 talks about the balance sheet and changes in equity and notes thereof. And Part 2 of Division 2 talks about the format of profit and loss accounts and notes, and part 3 talks about the general instructions for preparation of consolidated financial statement, and this schedule 3 does not talks about the cash flow statements. There have been different amendments also in schedule 3, division 2 of schedule 3. First it was amended in 2016, and Schedule 3 was amended in 2016 for inclusion of India's format. Then later on, it was amended in 2021. And financial statement of company that is following India's should be in compliance with India's Schedule 3, ICA's guidance note on Division 2 to Schedule 3, and relevant provision of Companies Act and other regulatory requirement. Objective of it is to provide the guidance on the amendments to Division 2 to Schedule 3 and clarifies practical implementation of the issues that companies are facing while implementing it and ensure the conceptual consistency in financial reporting. So let's discuss some main points of this guidance. So first thing is that we need to discuss about the property, plant and equipment. So there is presentation difference between the Ind-AS and Schedule 3. Schedule 3 about the property, plant and equipment guides to separate disclosure of land and building as a two class of PPE. However, India's example suggests that grouping of land and building for the revaluation purpose. So in this case, where there is a difference between the India's and Schedule 3, then we need to follow the Schedule 3. So let's take a practical presentation. So this is a balance sheet of Infosys. If we check that land and building are separately disclosed in the notes to the accounts. Here property, plant and equipments are disclosed, and in the notes it is separately disclosed as per the requirement of Schedule 3. So next is capital advances. So advance for the purpose of capital assets that company has given have to be shown other as a non-current asset. So in some countries, CIP capital advances are shown as a capital work in progress. So here in this guidance note, clarification is given that in India we need to show it under capital advances, not in capital work in progress. So if we see, this is the balance sheet and it is shown as a other non-current asset and capital advances are part of it. So it is just a clarification, because in some countries CWI capital advances are shown as a part of CWIP. And in case of non-current asset, although it will be detailed disclosures and will be covered under Ind AS when we'll discuss Ind AS 32, 109 and 117. But requirement is that disclosure should be there of name, nature and extent and face value of the investment, and quoted and unquoted segregation should be there. Market value should be disclosed, and impairment loss should be shown separately, and treatment of FVT, OCI and impairment disclosure should be there. So if we check the non-current investment disclosures, so if we see, it is there: non-current investment in equity, redeemable preference shares, maturity funds, others, government bonds, etc. And here it is as directed, it is bifurcated in unquoted and quoted investment. Here it is quoted investment, and there is a further classification that it is carried at investment, carried at cost, and from FVT, fair value through profit and loss and OCI methods. Apart from it, the number of shares and face value of the shares is also disclosed, and there is a aggregated quoted investment and market value of quoted investment, market value of quoted investment, non-current, current classification is there, aggregation of unquoted investment, and the investment, those are carried at cost and amortized cost or through OCI or through PL, all are disclosed here. And apart from it, we need to uh, disclose the detail of amount that are recorded in OCI, and fair value of method of fair valuation with the class of the investment, method that we adopted, quoted price and market observable inputs on only on the basis of market observable input, or discontinued cash flow method, market multiple methods, the method of evaluation and fair value of that is also disclosed here. So in case of trade receivables, we need to classify the trade receivables from the sales of goods and services, and where we have the unconditional right. Apart from it, the receivables, those are not from the trades, will be shown as the financial assets, and we need to split the trade receivables between the undisputed and disputed, and this term of disputed and undisputed is not defined in schedule 3, and we need to show the aging of the trade receivables also according to the due date, and disputes to be considered for impairment assessment purpose. So let's see how it is disclosed in practice, in practical life. So this is a trade receivables, and it includes from the subsidies also, and this is the aging of trade receivables, and further it has been grouped in undisputed and disputed, and disputed, those are considered goods, undisputed, those are credit impaired, as the requirement was there for the impairment assessment also. So next is financial lease receivables, and schedule 3 does not specify disclosure. However, guidance note clarifies that it should be disclosed under current and non-current bifurcation, and apart from it, current assets should be again bifurcated between current and non-current. And what is current and non-current, that will be discussed when we'll discuss about Ind AS 1. And cash and cash equivalent, it includes the cash, demand deposit and short-term liquid investment, and bank overdrafts repayable on demand. This is treated as borrowings. It is not considered as a cash and cash equivalent. And in cash flow statement, overdraft form part of cash management can be done, but at the presentation purpose in financials, we cannot include it in cash and cash equivalent. Apart from it, next is current assets, current tax assets. So that excess tax that we have paid will be shown as a asset, and if not recoverable within 1 year, it will be shown as a non-current asset. But DTL and DTA will not be classified as a current and non-current. It will be always non-current because we don't know when the DTA or DTL will be adjusted. And in case of equity share capital, we need to define the equity based on the substance, where it has the residual interest, not based on the legal form. So the preference share capital can be also the equity. Debt also can be the equity. This we will discuss in detail when we'll discuss about 32 and 109. And instruments entirely equity in nature, that is convertible preference shares meeting equity criteria, will be disclosed under equity. And in case of borrowings, disclosure of term of repayment should be there, and current maturity of long term debt. Although the debt is long term, but it is going to be due in a shorter period, will be classified as current borrowings, and we need to show balance under non current borrowings. The portion that is falling due in short term will be shown as a current, and balance that is not falling in short term will be shown as a long term borrowing. So if we see the disclosure, this is from Reliance. It is shown as borrowings at amortized cost and unsecured, and here it is classified in non-current, non-current and current. And this is the aging of term loan, 1 to 5 year and more than 5 year. Similarly, trade payables we will classify if it arise from the purchase of goods and services in normal course, and we have to split it in dispute and undisputed category. And aging should also be displayed, and dispute defined as per the insolvency and bankruptcy code. So here we can check in practical life, it is defined divided in category less than 1 year, 1 to 2 year, and like this, and disputed and undisputed also disclosed. And here there is a requirement in MSME Act that the payable to MSME category vendors should be shown separately. That's why it is shown separately here. So next we need to discuss about the current borrowings. Loan payable on demand are treated as current, and it includes all the loan payable that is within 12 months, and default as on reporting date to be disclosed item wise. Next is other current liabilities. It includes the trade deposits and security deposits, statutory dues. And in case of contingent liabilities, guarantee given for the third party obligation is considered as a contingent liabilities, and self obligation where we have given the own performance guarantee is not contingent. And current guarantees to bankers, counter guarantees to the bankers non shown is not shown as a contingent liability. Revenue from operations and other income, it generally the GST VAT etc. are excluded from the revenue. And revenue presentation, gross versus net of tax, depends on the principal versus agent roles. And other operating revenue is equal to the income from ancillary activities, not from the product and sale. Revenue from the product and sales will be shown under the revenue from the operation, not from the other income. So let's see the presentation. So here it is value of the sale, income from the services. This is inclusive of GST, and now GST has been reduced. And finally, we have come on the revenue from the operation portion, and the other income that is not from the sale and services is shown separately as a other income. So next is exceptional items, and in case of Ind AS or Schedule 3, in exceptional items are not defined. And in Ind AS 1, it says that disclosure required for the material items affecting the financial performance of the entity. Examples may be inventory and property, plant and equipment when they are written down. and restructuring cost, disposal of PPE and investment, litigation settlement, and discontinued operations. So this is all about the introduction to India's. So if you have any query or any disclosure requirements, we can any clarification you need, we can discuss it on the given mobile number. Let me show you the mobile number here. You can check, and if you have any clarification, any doubt, we can discuss it about on the given number. Namaste.